What are the financial products a skeptical investor, and this is the Skeptical Investor book by John Lawrence Reynolds, what are the products that are a bit somewhat flawed? John, last episode we talked about the flawed advice givers. Now we're going to talk about the flawed products that these flawed advice givers are providing.
Yeah.
What lists your list of bad investments?
Well, just to get into this, I'm always impressed by the fact that the investment industry seems to spend as much effort coming up with new products and marketing them as they do for managing them. We saw things like principal protected notes, for example. Now we're seeing things like actively managed indexed funds, which is an oxymoron immediately. And these items are designed primarily to line the pockets of the people who market them and manage them. If you look at principal protected notes, as I do in the book, I think there are 5 layers, 5 places in a principal protected note, which, by the way, guarantees that over the term of the note, 3 years, 5 years, 10 years, even more, you will at least get back your original principal, which sounds pretty good, plus any earnings as a result of investing that money into the equity market. So that sounds pretty good until you start digging into it. And one of the things you look at is, as I mentioned, 4 or 5 areas where whoever sells you the principal protected note gets the first chance to pull out some money from it. So after 10 years, you're guaranteed to get your original money back, but a lot of it's gone into the pockets of the person who sold you the note. This is wrong.
I think the Ontario government put out there was some regulatory attention paid to PPNs at one point.
Yeah, there is, and from time to time, people like the Ontario Securities Commission and so on invest a lot of money to get these brochures out there, and the brochures are wonderful. But come on, who's reading them? Who's heeding them? Who's changing their activities, their decision-making as a result of them? Darn few. This is one of the points of the book, John, I really want to come through to your viewers, is that RSP investors, especially those in their 50s and 60s, have got to start educating themselves about how this industry works and how they can use it to their advantage and build up their retirement plans. Because as we all know, private sector pensions are vanishing as quickly as the buffalo were off the prairies 100 years ago. We've got to start taking charge and responsibility of what we do in terms of our decision making. That's the point of the book.
So you're saying be skeptical of wrap accounts, mutual funds, actively managed ETFs, anything that has layers of fees, etc. So does this mean, therefore, you believe in direct investing in stocks and bonds through a traditional stockbroker?
That's not such a bad idea. What I'm proposing in the book is a combination of a couple of factors. I'm very high on index funds, ETFs, exchange-traded funds, which, as you know, trade on the market as simply as stocks do. Combine them with a dividend reinvestment plan, and you've got essentially a no-brainer of a bit if you get a broadly based index fund covering, let's say, the S&P Toronto Stock Exchange basis. That's a pretty good index to use as a basis for things. Put them into a drip plan, you're doing very well. I also like the idea of putting perhaps 15 to 20% of your RSP balance into blue chip dividend paying stocks, also on a drip arrangement, a dividend reinvestment arrangement. You know, we can grumble about our banks with all kinds of justification, but they are solid, they are making money, they are conservative, they are going to be around 15 or 20 years from now. And we have some other substantial companies, Bombardier, Potash, I like. Certainly the utilities are doing very well as well.
You're saying stay at home, don't go foreign.
I'm saying stay at home, yeah, for the next 2 or 3 years, because things are going to be very volatile globally, and people will say, well, that's a chance to make money, and it's a chance to lose money. And I think your RSP should be the most conservative portfolio package you make in terms when it comes to investing.
Which traditionally meant ladders of strip bonds, but as an ETF proponent, you would suggest even bond ETFs are okay?
I think bond ETFs are okay. I personally like the idea of strip bonds. I mentioned a very good financial advisor from British Columbia in here who says that when his clients get into their 60s, he begins buying strip bonds that mature in the year that they retire. And this gives a nice solid feeling. It's kind of like, warm chicken soup when you're not feeling very good, in the sense that you get into your 60s, you look ahead to, you have to convert your RSP into a RIF at age 71. And here at age 71, you can add up all the government-backed guaranteed bonds that are going to mature on that date. And that gives you a foundation that simply is unshakable.
Thanks very much, John Reynolds, the author of The Skeptical Investor.
Thanks, John.